investors and traders, and welcome to the weekly market report. I'm AJ Monte, Chief Technical Analyst with Sticky Trades, and we are in the final minutes of the trading day here. You should hear the closing bell real soon. Before we get into the charts, just want to let you know that we'll be closed on Monday. That's January 15th for Martin Luther King Day. The markets will be closed. I will still be doing my Monday night webinar, so for those of you who are option traders, you can tune in then. If you can't make it, then the session will be recorded and you won't skip a beat. Now let's look at the Dow as we're coming into that final minute. We are closing with a red candle right there, and you can see down below the CCI is hinging lower. It's actually a full-fledged pivot point, and we're on our way headed towards that zero line, which is the black line. That's the momentum line. If we cross down below that, we will generally expect a 2 to 4 day continuation of selling, as that is the norm for that particular momentum line. Now, my downside forecast right here is still in place at 365.10. There's the closing bell right there. And you can see that we are more or less stalled at the top here. So today's red candle is significant because it means that these folks, anyone who's bought in this area, is still kind of hovering around the break-even point. So if on Tuesday when we open up, we start trading below that 20-period moving average, then that will put more selling pressure into the market. And then from there, I think we could go lower. If you look at the weekly chart, you could see how overextended we really are. We're a long way away from that 20-week moving average, and I think we'll eventually wind up right back on that. So going back to the daily chart, there was one other thing I want to point out, and that is these gaps. These gaps down below are still open. I'm going to talk a little bit more about gaps, particularly in the VIX, when we get to the end of this session here. But that is DIA. Now, if we go to IWM, which is the Russell 2000 ETF, you can see here that we did hit my upside target right there at 197. We have a drop in volume on the way up. The oscillators are still going up, but they're mixed. So I still think we're going to go back up to this high here around that moving average. I'm just going to put a little red arrow right there to highlight where that moving average is. So I think we're going to go up to that moving average once again, and then I think we're going to start to make our move lower, ultimately taking out the low from yesterday on the 11th. So that downside target ultimately is going to be 191.11. Keep that in your sights, keep your eye on the charts, and we'll report back on that when we get to the midweek report next week. Looking at Qs, that's the tech sector. We hit my upside target there as well at 404.13. As I mentioned last week on the weekly market report on Friday, I said I didn't think the oscillators would even get up into the overbought territory, and I still feel that way. We filled the gap here. That's what that horizontal line represents. We filled that gap, so I'm going to remove that line and now draw my forecast back down. I think because of the shortened trading week next week, we'll have to see whether or not there's going to be enough selling to keep that momentum going to the downside. But my downside target is going to be right there at 401.89 for the Qs. Now, SPY, this is interesting. I had a two-part forecast on that where the upside target was hit at 471.44. We're right at this high. I'm going to draw that horizontal line. See that high resistance? And while we don't have a half signal or a pivot point just yet, I still think that downside target is something I want to keep in place right there at 464.91 with a secondary target down here at that green dotted line at 450. Again, looking at that weekly chart, you can see how overextended this is. This looks very much, if I go even further back to the monthlies, this looks very much like an M-top. Just go on Google Images and search for M-top patterns, and you'll see that's a textbook M-top if I've ever seen one. And that is for SPY. Now, I want to talk a little bit about the VIX here. And you can see that after this stretch of green, remember last week I said we would go down to test that 20-period moving average. We did that, but now we have a green candle and this is a half signal. What is a half signal? Well, a half signal is half of a pivot. A downside move with an upside pivot would entail a higher low and a higher high. So we have the higher low, that's the half of the pivot, but we haven't seen, at least not yet, we haven't seen a higher high. So that's a half signal. If we get a higher low on Tuesday with a higher high, that will be the pivot. I'm just maintaining that upside target at $18.11. Now, I'd like to do a shout out to Elena. Elena is one of our followers on YouTube, and I read all the comments that come in, by the way. I may not answer all of them, but I read all of them. And Elena had a question about the VIX and a gap that is back in 2018. It's still open, and I couldn't find it because my charts are set on a daily interval, and I go back maybe 5 years max. So I kept looking, and I still couldn't find it. So I had asked Elena, and there we go. There's the back and forth on YouTube, and just came out about a question about an open gap that was still there. Now, if you've listened to me on YouTube, you've always hear me say that 100% of the gaps fill on the VIX because it's an oscillating index. Well, guess what? Thanks to Elena and her good research going back every single day looking for gaps, I can no longer say that. I have to retract that statement and now say 99.999% of the gaps fill on the VIX. Now let's take a look at what that looks like on the charts here. I have to go back to and reset my charts. Actually, I had to go back and look at the max time frame on this. I actually had to scroll down because it wasn't even in my menu. And I went there and I'm looking, I can't find it. I'm going back and I'm scrolling. I mean, I really took some time, Elena, to find it. And then right here, I found what you were talking about. It's this little itty, I gotta really magnify this. It's this little tiny little gap down here. It's only about 5 cents wide. It's on this day. It's on January 29, 2018. And if I highlight that for you, you can see there's just a very small little space between this high and this low. And so thanks to Elena, I now have to retract what I've said in the past with regard to 100% of the gaps filling on the VIX. I stand corrected. I'm going to have to now only be able to say 99.9999% of the gaps that have formed on the VIX have filled. So thank you so much for that. I stand corrected. I got to keep it straight, right? We got to keep it truthful. We got to keep it honest. And so that is absolutely true. I don't know if it's going to fill that. At this point, I certainly hope we don't, because then that means if we go much higher, the fall from the top is going to be that much greater. Now let's go right into the geopolitical news here. You could see that when I look at the charts, I follow the 7-point trading checklist. And this is nothing more than weighing the evidence. So everything that I put out on this weekly market report is based on this checklist because I have this in my head. We wrote this down a while back thanks to one of our members, Laura, and James actually came to one of our seminars, and she said, what do you look for in these signals? And how are you determining, more bullishness and bearishness? So I went back to my hotel room that night and I wrote it all down. And again, thanks to Laura, we have a 7-point trading checklist because I've taken what I've had in my head for all these years, put it on paper, and now our members can follow along with me as I go through the charts. So again, back to the geopolitical news. This is looking out globally now. There is over $3 trillion of wealth, total wealth destroyed so far in this month globally now. This is not just in the U.S., this is globally. And this is one of the things that I look at because the markets have not responded to any of this data. It just seems to want to keep going higher, but I think it's going to break, and I think it could break very soon because if you compile everything that I'm looking at here, this is consumer credit. I talk a lot about this, but in November, consumer debt soared to the second biggest surge in credit history right there. You see that circled right there. Now, folks, think about this for a moment. People are literally living off of their credit cards. And when those max out, what's going to happen? They're going to have to file for bankruptcy. So we're seeing this start to pan out. I believe we're already in a recession, but it's not being reported, at least not yet. But here's another bit of information. I haven't even gotten the good stuff here yet. Office space vacancy rate in the U.S. has reached its highest level since Jimmy Carter. And I had a conversation this afternoon with one of our members named Dan, who is in the real estate market in California. And he said this is absolutely true. So why does that affect us? Well, when offices go vacant, the surrounding businesses suffer. Think about it. Starbucks is not getting the foot traffic that it used to when the offices were filled with employees. You have the local delis, right? The lunch counters and such. They suffer. And that just goes on and it trickles out throughout the local economies and then into our U.S. economy. Here's another one. I give credit for this one, A Game of Trades. Please follow them on X. They put out some really good research. The surveys that are coming out by consumers are showing the lowest levels with regard to confidence in buying homes that we've seen in a long time, since I was 2 years old. And so this is amazing because, again, we're not seeing any reaction to this yet, but I see this as being more of a 6-month lead indicator. So between now and June, this could be very, very interesting. But this is the most important slide, I believe, of the batch here. And this is something that I've reported on quite often. That's the money supply, M2. It is now contracting at speeds that we haven't seen in only maybe a handful of times since 1830. So the drop that we're seeing here in the contraction of the money supply is as dramatic and maybe even more dramatic than what we saw right before the Great Depression. You see back here was the contraction in the money supply prior to the crash of 29 and then following into the Great Depression. And so that is a very serious indication right there. Again, that seems to be ignored by the financial media. And when you think that's something, we're looking now at the 10-year minus the 3-month Treasury yield curve. And again, this is only the 5th time that we've seen something like this happen. And we're talking about indicators that are basically guaranteeing us that we're going into a recession, a depression, or maybe even something worse, which could be perhaps an economic meltdown right across the board. So when I go out there and I tell people, watch out below, I'm not just like, watch out, the sky is falling. I still take long positions. In fact, yesterday we took a new long position in the energy sector with our members. But I've told them, as I will tell you, that I believe that the healthiest outlook that you could have right now is a long-term bearish outlook while still maintaining long positions every now and then when the charts tell us. Go to our website and you'll see that stickytrades.com is an educational company that puts out trade publications. And that's where I spend most of my time, analyzing the charts, writing about those, doing videos for our members, showing them the technical indicators. And that's the platform from which we've launched in July. So if you could, please remember, hit the like button, hit the subscribe button if you haven't already, hit the notification bell, and please, I love your comments. Look what happened today with Lena. Thank you so much again, and I look forward to these videos. I hope you enjoy watching them. So I'll talk to you on the next video, and you have a great long weekend. So long.